Hey traders, this is Blake Morrow with Traders Summit, and I have my favorite person to talk financial markets with, Marc Chandler from Bannockburn Forex. Gosh, I almost screwed that up. How you doing, Marc?
Good, thanks. Great to be here with you.
I always screw that up. Good to be here. I'm so happy to have you here. You know, and there's no better person to actually talk about what's happening with the Fed than you, in my opinion. You know, I've a person who's been a big fan of yours over the years, over the last 20 years, seeing you on Bloomberg and CNBC and reading your books. I got to ask, what is the Fed doing from here after they raised rates 75 basis points last week? What do you think?
Yeah, isn't it amazing?
It is.
On one hand, everybody's critical of the Fed, too slow out of the gate. And now that they've come out of the gate, they've got like both guns blazing. Not only are they raising rates more aggressively than we thought, we being the entire market,
right,
but also the balance sheet is shrinking, and it's going to be at an accelerated pace at the end of the summer, where it's going to be doing twice what it was doing in the last time round. So the Fed's off on this aggressive path, and so I think certainly to unbuckle it a little bit, unpack it a bit, is when the Fed says that they're moving expeditiously. I think we now know what it means. It means that they're going to raise rates as fast as they can without disrupting the market. So after that CPI print and that University of Michigan consumer expectations number, there are some banks who right away talked about 75 basis point hike before the media got hold of that story.
Okay.
And so the market priced it in, and I think that the Fed was happy to deliver to them. In fact, that's what the St. Louis Fed Bullard argues is about the key to Fed's credibility. It's given this forward guidance, and now it's got to make good on it.
Right.
Ratify its forward guidance. And so the forward guidance now, I think the market is strongly biased towards 75 basis points in July. And then the market is leaning towards, but not quite 50-50 yet, of another 75 basis points in September.
So that's really going to tighten the clamps down on financial conditions, if you will. And how do you personally, Marc, how do you define financial conditions tightening? What does that mean to you?
Yeah, so I think it's not so much what it means to me. I think what the Fed uses these words, I think what they're telling us is that they want to see, in effect, higher interest rates, lower asset prices. Higher interest rates, so the Fed's telling them we're going to be raising interest rates. So the market, they want to see higher interest rates. And when you have higher interest rates, you'd expect to see other financial assets weaken. So a weaker stock market. I mean, of course, we've seen some really messy days.
Yeah.
And some days in which you really have to like clench your stomach, seeing like 3-4% like pullbacks or sell-offs, and closes on the lows, or sometimes we close on a high and started like try to suck in the bottom pickers, and then just like we saw the other like last week or so, the gap lower openings.
Right.
So I think that the idea that the Federal Reserve has our back, the Fed put, I never really believed it myself. I always thought that it was like a gross exaggeration from the Fed, and I think that Powell has helped underscore that by saying that that there's no such thing as a Fed put, that is looking at broader financial conditions, which means that if you're thinking to buy stocks because the Fed's going to be behind you, don't count on it. I think that the Fed wants to see tighter financial conditions. A weaker stock market's part of that.
And what breaks the back of the Fed where they stop with the hawkish rhetoric? Is it how about if Bitcoin drops from, I know we were just mentioning how Bitcoin, had a slump towards 20,000, traded below that over the weekend, maybe got out some weak hands. But how about if Bitcoin trades to 10,000? What does that mean to the Fed? Does that mean that they've broken something yet?
Yeah, I don't think that. So I think that when the Fed talks about tightening financial conditions, it's not only stocks and bond price they want lower. They want a full range of assets, and especially those assets that are seen to be, whether true or not, we could debate about it, I suppose, but they want to see, especially the speculative assets that were juiced up by low interest rates for arguably too long. And so having those prices of speculative assets weaken, I think that sort of reaffirms, I think, to the Fed policymakers that they're on the right course. So the weakening of crypto, I think they would regard it as a healthy development, even though it's painful to many of us.
Yeah. And so, where do you think? And it may be painful for a lot of retail at this point, but where do you think that the Fed, or what gets the Fed to the point where they're like, enough is enough. We've raised rates to where we should.
Yeah, so it's an interesting problem the Fed has, right? Because they want to slow things down, and these policies and effects that they have take place with a lag time. So it's almost, it's like, try to think of like some of those old movies we might watch where the audio track is not in sync with the video track.
Sure.
And I think it's something like that, trying to conduct monetary policy. So I think that the Fed will keep going. They won't be convinced that things are slow enough until something ends up telling them that they've broken something. And I thought of, in anticipation of our talk today, I thought of a few numbers that traders, not just macroeconomists, but traders can keep an eye on for themselves as sort of mile markers along the way towards this economic slowdown, which has already, I think, begun.
Now, I think that might be a cue for those people that are listening in right now to do a couple of things. Grab a pen and a paper, and also give Mark a thumbs up if you're watching him on YouTube right now for spending his time with us here on Trader Summit. So, Mark, let's hear those numbers.
Okay, so the first one is 4.
Okay,
and that really refers to Lawrence Summers, who's really emerged as this like constant critique, like a dog barking at the administration on Fed policy, on fiscal policy. But he's got an interesting case he builds, I think, that whenever the economy is growing, whenever inflation is above 4% and unemployment is below 4%, like now, he says the economy is outside of its guardrails, where it does the best. And to put the economy back in the guardrails after you get that 4%, above 4% inflation, below 4% unemployment, to get it back within those guardrails ends up getting the Federal Reserve to engineer a recession. So the first is sort of the underlying case then, this 4x4. We're already in those conditions now, which is really the basis, not so much the yield curve, which reflects that, but these conditions that the Fed's trying to get us back within.
I see.
That's the first number just to keep in mind, so it's a bigger backdrop.
Okay.
But to see how we are towards like breaking something, one number to be watching is 0.5. When the 3-month average of the unemployment rate rises by more than 0.5%, that has been a good signal that we're in a recession. So 0.5% increase on the 3-month moving average, and in fairness, the 3-month average is just basically on its lows, around 3.6%.
Okay.
So that's no sign from the labor market, which is Powell's point, no sign from the labor market that the economy is rolling over, not yet. The other number to watch is 800. And that's supposed to be the spread between the high yield junk bonds and treasuries. And when the spread gets that wide, that is really a tightening of financial conditions. Here's a highly speculative asset that people obviously don't want anymore.
Yeah.
And that's just a tightening of the financial conditions. How tight? 800 basis points, that spread. And right now we're about 550.
Okay. So we're about 550 right now. So we've got some distance to go.
Got some distance to go, but it's elevated and moving in that direction.
Okay.
And the last number gets us back to the labor market, but not the unemployment rate, but the weekly initial jobless claims. So what economists will do, they'll take a 4-month moving average. Because it's a high frequency number, it can be distorted by a holiday, by bad weather. And so we take a 4-week moving average to smooth it out. The 4-week moving average bottomed 2 months ago at about 170. We're at about 218 now. And the number to keep in mind is 238. That was the 4-week moving average at the end of 2019, before COVID. And that 238 was itself a 2-year high.
Okay.
So in a big picture, what happens, right, is that the economy is weakening. Some of us thought we were headed for a recession. We get COVID, drops us, like collapses the economy, and we've climbed out of it quickly because of the huge stimulus, fiscal and monetary. And now we're dealing with the ramifications, so the aftermath of that, and the breakdown of supply chains, and the higher prices, the different work style, the lifestyles.
So when you put all that together, Mark, those 4 numbers that you just gave us, if they all start triggering that, in your mind, the Fed would be closer to maybe getting close to this rate hike cycle being over. Is that correct?
Yeah. So, but the thing is, going to have to take some time, and so I think that by the time we get there, that by the time there's this more convincing evidence that something's breaking. Right now, things are just slowing, and we can debate about how fast they're slowing.
Yeah.
And how much the Fed doesn't want, how much of this is desirable slowdown. But I think that towards the end of this year, it's going to become clearer that the Fed funds rate is above what most Fed officials think is the equilibrium, the neutral rate. So they'll already be not just reducing the accommodation, but actually tightening monetary policy. And so if they stop, my guess would be the window would probably be Q1 or early Q2 of next year.
Well, Mark, I don't think there's anybody out there that puts it quite like you do on how to understand the markets and putting it all together, especially when you're talking about Fed policy and the economy as a whole. I tell you, one of the things I do love about you is every day consistently you put out your thoughts so everybody can read them. They can read them here on Trader Summit. They can read them on your blog. Can you tell traders how to follow your work more consistently on a daily basis?
Well, I appreciate you guys posting the commentary, because I think that, like, I even though I've been doing this for a while, I really do think that we live in a world in which the old-fashioned idea of valuation is scarcity. And you make scarcity by charging a lot of money for a product or a service. And I've been really fortunate in my career to basically work for an institution that have been happy for me to make myself publicly available. In some ways, that's what makes things valuable these days, right? Is that my email, I use, what do they use at work? Microsoft Outlook. And what makes it useful is that I can email anybody in the world who's got another email, even if it's not Outlook, Yahoo, Gmail. And so what I want to do is sort of my hubris and my pride is that I would like to participate in the discussion. Not that I always have the right answers, but I just want to participate in the discussion of sort of the issues of the day. And the issues of the day are, I think, end up to be two things: prices and developments. And there's got to be some relationship between those events. And so that's what I wrestle with, and I'm happy to share my thoughts. You know, as you say, at my blog, Mark to Market, which really comes from my first book called Making Sense of the Dollar. And there I just try to, think about what's happening. I mean, the book came out between Bear Stearns and Lehman at the beginning of the financial crisis. And this is when people said that the dollar was losing its place in the world, that all these declinists, America was lost, and all these things. And so I kind of thought that my book was a way to address those arguments, because I kind of think those arguments happen every generation.
Sure.
And I thought that using the summary of my work experience at the time, about 20 years or so. And so Mark Making Sense is the blog. My Twitter handle is Mark Making Sense. The blog is Mark to Market. And then you can, of course, I try to, when I post something on my blog, I try to put something out on Twitter. I'm good for 3 or 4 posts a day on Twitter, I suppose. But I think that, I have an open DM. And so people should feel free, whether, complaints or ideas, happy always to entertain things. So well, thanks a lot for the opportunity.
I tell you, I thank you for spending your time with the Trader Summit community. I appreciate you. And if you're listening at home or your home office, make sure you give Mark a thumbs up and subscribe to the channel so you don't miss any of our content here with Mark. Mark, thanks for spending your time with us, and we'll catch you on the next one.
Great. Thanks a lot. Good luck to everybody.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.